Hello, everyone, and welcome to this Sustainalytics webinar on our new Thematic Research Report, 10 for 2018, ESG Risks on the Horizon. My name is Dana Lindley-Jones, and I'm the Director of Sector Research here at Sustainalytics, and I'll be the moderator. The next slide, please. So before we begin, I just want to highlight some housekeeping issues for you. So you're currently muted, and you'll remain muted for the duration of the webinar, just to minimize noise disturbance. But we do invite you to send any questions you have about the report or the webinar to us through the interactive box that you see at the bottom of the screen here, highlighted with the number 1. Incidentally, if you have any audio problems during the webinar, you can also inform us of that through this interactive chat box. If you want to minimize this panel, you can do so by clicking on the arrow at the top, indicated by the number 2. And lastly, this webinar is being recorded, and a copy of the recording will be sent to all participants in the coming days. Next slide, please. So thank you for taking the time to join us today. I know it's hard to find time in your calendars for such webinars, so I'll provide a very brief introduction to Sustainalytics, and then we can move into the content. So Sustainalytics is the largest pure-play investment research and ratings provider dedicated to responsible investment and environmental, social, and governance research. We have 25 years experience in the fields of ESG and corporate governance research and analysis. We have over 350 professional staff, with more than half of which are engaged in research. We provide ESG and corporate governance ratings and research on more than 7,000 issuers worldwide. And we serve over 450 institutional investors from 22 different countries. So in short, we help investors integrate ESG and corporate governance factors into their investment processes. And to that end, Sustainalytics produces research in many forms, and one form of that research is our thematic report. So today's report is the 10 for 2018 ESG Risks on the Horizon, and it's actually the 4th in the 10 for series. Previous year's reports are also available on our website if you want to have a look at some past calls. So I'm joined today by 3 of the report's authors, Doug Morrow, Joshua Zakai, and Saeed Moeenuddin. Now, Doug is the director of the Thematic Research team, and he's a lead author on this report. Joshua is our lead analyst in the food sector. He's very knowledgeable on the challenges in the palm oil industry. Moeen is our tech, media, and telecom analyst, and he'd be happy to speak to any clients about the tech giants and some of their recent behavior. So on this call, Doug will speak about water management and climate change, and Joshua and Moeen will focus more on the consumer protection issues. The presentation should take about 40 minutes, followed by a Q&A session, and we will aim to finish the webinar by the end of the hour. So just a reminder that if you have questions during the webinar, to please submit them via the chat box. Without further ado, then I will pass it over to Doug to get started.
Thank you very much, Dana. So I think to start, I'll just give a quick summary of what we're going to talk about in the webinar today. So I want to begin by giving just a quick backgrounder on the 10-4 series, and then we'll jump right into the stories. So as Dana said, we'll be presenting 6 stories today. I'll take a look at 4 of the stories, and Josh and Moeen will look at 2 stories. And then we'd like to take a look back at our selections from last year, 10 for 2017. We'll do a quick look at how those companies have performed over the last 12 months from an ESG and total return perspective. And then we'll conclude just by summing up the main points, and then we're happy to jump into the Q&A. So in terms of a quick backgrounder on the 10-4 series, as Dana said, this is the 4th iteration in the 10-4 series. And essentially what we do with these reports, it's one of our flagship reports on the Thematic Research team, and it gives us an opportunity to provide analysis on 10 forward-looking themes for the year. And in previous years, as some of you may know, we've taken a look at upside opportunities, investment themes that we see developing in the economy. We've also done a specialty report on climate change back in 10 for 2016. This year, we decided to switch gears a little bit and focus more on what we see as downside risks related to ESG issues over the 12 months looking ahead. And while the risks are fundamentally industry specific, you'll see here, as you can see on the slide, they're also grouped, they can be grouped under 4 broader headings. So these are water management, climate change, consumer protection, and stakeholder governance. So with that, I think we can jump into the stories, but first let me highlight that the themes and the issues and risks you'll be hearing about today are very much global in scope. So we're talking about things that hit home and hit the operating environment of companies based in many different regions and countries across the world, including all of North America, good chunks of South America, all of Europe, as well as significant parts of APAC and Africa. Okay, so in terms of the stories, so as Dana said, we'll be taking a look at 6 stories today in the interest of time. But for those of you who would like to see the other 4 stories, we encourage you to go to our website where you can download the full report or the executive summary. So the first story that I'll talk about today concerns the copper mining industry in Chile. And for those of you on the call who follow copper prices and metal prices, you'll certainly be aware that copper is on an absolute tear at the moment, currently over 7,150 US dollars a ton, which is up from about 7,000 when we wrote this report a couple of weeks ago, and up more than 70% since early 2016. There are a lot of reasons for this. Certainly one that catches our eye, though, is the upside that copper producers face as a result of the EV rush, the electric vehicle rush, because, you know, while most investors might think of lithium or cobalt as a way to play the EV rush, it turns out that there's actually appreciable amounts of copper in lithium-ion batteries as well. So just an interesting sort of tertiary demand driver for copper. But what we did in this piece, we took more of a downside look, and we said that you know, despite these strong fundamentals, we actually think that a lot of copper producers in Chile may have difficulty capitalizing on this demand pattern due to what we term water-driven community opposition. So really the nexus between water scarcity and community protest. The nature of the problem is actually quite simple. It's that Chile is already under significant and growing water stress. And what that means is that mining companies and local communities are therefore competing for an increasingly scarce resource. And there's also the issue of contamination of water supplies from tailings dams and mining waste and things like that. So just as one proxy for, you know, for this risk, in neighboring Peru, there are currently over 200 conflicts right now between mining companies and local communities, and most of these, not all, but most of them center on water use. So really important issue right now for mining companies across South America, not just in Chile. We certainly don't think this is an issue that's going away, you know, anytime soon, just given the scope of the problem. And we think it makes sense for investors, you know, to consider how their mining holdings are positioned on this risk and how they're taking steps to mitigate their exposure going forward. So to that end, what we did in the report was analyze 6 mining majors that are active right now in Chile's copper industry, and we analyzed them on their water and community risk management capabilities. And as you can see on the slide on the top right, actually BHP Billiton performed best on this analysis. But Antofagasta was a close second, and we ended up profiling them in the report because, on the one hand, unlike BHP, they are a Chilean pure play, copper pure play, and we also think that they're trending in a really good direction, so maybe even better than their score on this metric indicates. Now, to be totally clear, Antofagasta has faced controversy in the past. It's faced opposition from local communities, as well as significant fines, notably related to their Los Pelambres mine. But in our view, they've really turned an important corner and are well positioned compared to their peers to compete in this environment going forward. Now, some of the things we like about Antofagasta, they've pioneered the use of thickened tailings technology, which helps reduce the amount of water consumption. It's increasing its use of seawater, investing in desalination technologies. But I think most importantly, and this is something our mining analysts would certainly you know, agree with, the company's shown a real willingness to genuinely collaborate with local communities when it comes to project development, which is something that we consider to be not just a nice to have, but an absolutely essential precondition for success in today's mining industry. So our next story looks at the oil and gas industry, and I mean, clearly in this day and age, you cannot write a report, forward-looking report about ESG risk without talking about the transition risk facing the oil and gas industry. The argument that we put forward in the piece is simply that the oil and gas industry, as a result of changing energy patterns, which are driven in part by carbon regs, is facing structural headwinds. And we think that these changes are likely to significantly affect the profitability of oil and gas companies in the future. We are certainly not alone in making that argument. So in that respect, we're probably not, we're probably a little conventional. But nevertheless, when these financial effects start to hit, the share price and the revenue streams of mining companies, I think is still anyone's guess. But the point is, in the long run, this is definitely an industry that faces, as I said before, structural headwinds in an economy that is trying slowly but surely to shift onto a low carbon trajectory. Something else that our oil and gas analysts will talk about a lot, and they publish reports on this, is also the demand destruction that the industry could face over the short run from the EV rush, which I talked briefly about in the last story on mining. And in many respects, I would say this actually poses a greater risk over the short run than the broader transition risk to a low carbon world. So as those of you who have spoken with our oil and gas team know, our house view here is basically that oil and gas companies at the greatest risk against this backdrop are those with higher average production costs, those where carbon intensive projects such as oil sands mining make up a relatively large share of their total revenue stream, oil and gas companies that are not taking steps to diversify their product lineup, as well as companies that are trailing on general greenhouse gas management. And it's really that last point that we pick up on in the story. What we do is we leverage some of the early insights from an indicator that we're developing right now and will soon be rolling out to clients. It scores oil and gas companies on their greenhouse gas risk management capabilities. You can see there on the slide in the top right corner. This work was really inspired by a lot of the TCFD recommendations that I'm sure everyone in this call is familiar with. And it seeks to measure oil and gas companies on initiatives to measure, disclose, and manage the multifaceted risks posed by climate change, including regulatory, market, reputational, etc. So again, as you can see on the slide, Royal Dutch Shell is one of the companies that we really like on this metric. In particular, some of the things that have grabbed our attention are the company's sale of its Arctic and oil sands assets that have really helped improve the carbon footprint of its asset portfolio. The recent acquisition of New Motion. So this is an EV charging pioneer. I think in some ways this signals management's awareness of the importance of diversifying, albeit gradually, their total revenue stream. Although, make no mistake, Shell is, the main business very much remains the sale of oil products and petrochemicals. Moreover, Shell was also the first large oil company to set a carbon footprint target. It aims to cut the net carbon footprint of its product suite in half by 2050. So these are some of the things that have grabbed our attention about Royal Dutch Shell and why we think it's relatively well positioned compared to its peers to compete in this industry going forward. So with that, I'll pass to my colleague Josh, who can give a synopsis of our next story.
Thank you, Doug, and thanks everyone again for your interest in the report and for joining us today. The trigger for the piece on beverages is that the food and beverage industry has been experiencing a shift in consumer preferences in key markets for a number of years. Consumers are increasingly demanding more foods that they perceive to be healthy and or sustainable. And we actually first highlighted this trend back in our 10 for 2017 report, where we focused on the upside potential for companies breaking into the market for plant-based proteins. This year, we're looking at the same trend, but we're looking at downside risks for companies with product portfolios that are heavily tilted towards sugary products with a focus specifically on sugar-sweetened beverages. Now, the concerns around the health impacts and of overconsumption of sugar have been percolating for years. Obesity is a complex issue, and there are many contributing factors to obesity, like physical activity, a person's overall diet, the types of lifestyle choices that they're making, But there is consensus that unhealthy weight gain results from an imbalance between calories consumed and calories expended. And while sugar occurs naturally in many foods, free sugars that are added to products in the manufacturing process can add calories without adding additional nutritional value. So I think that's where some of the concerns around sugar come in. With unhealthy weight gain on the rise across the planet and concern over the non-communicable diseases, for which the risk factor is increased with obesity, such as diabetes, cardiovascular disease, and some types of cancers, consumers are opting for products that they perceive to be healthier. And in recent years, we're seeing a historical trend of declining soft drink sales in key markets. The United States is a great example of this trend. It's experienced declining sales for soft drinks for more than a decade, not only the past decade. In addition to consumer trends, the World Health Organization has identified taxes on sugar-sweetened beverages as a potential policy measure that governments can use to address the growing burden of diet-related non-communicable diseases. And we're seeing some governments seize on this advice. Sugar taxes are either in force or coming into force in multiple jurisdictions. Some examples are Mexico, the United Kingdom, the Philippines, the UAE. In Mexico, the data shows 2 years after sugar taxes were introduced on sugar-sweetened beverages, that consumption of these drinks has declined by over 9%. And Mexico's taxes actually fairly modest when compared to the UAE's tax, which is set at 50% for soda and 100% for energy drinks. So in this context, beverage companies with product portfolios that are heavily tilted towards sugar-sweetened beverages are facing a fair amount of exposure to these trends. Companies are seeking to mitigate this risk in different ways. One way is through portfolio diversification, and that can include a greater focus on low or no-calorie beverages or premium and functional products. Another thing that we're seeing in this space is self-regulation with regards to how, where, and to whom companies will market and sell their products. But at the same time as we're seeing these positive actions take place, we're also seeing mounting concern over how large companies operating in the space may have influenced the public debate on a healthy diet through scientific funding on wellness, or also on lobbying related to sugar taxes. And looking at this mix of exposure and the mitigation techniques that companies are putting in place, we thought that the Coca-Cola company would be an interesting case to profile this year, because it presents a good example of a company that is taking proactive steps to limit exposure that we view as positive, but it's also facing ongoing exposure from its portfolio and from the types of lobbying and scientific funding activities that it's engaged in the past. So on the positive side, the company is introducing low and no calorie options. It's shrunk the portion sizes for certain products, and it's also investing in new brands that are appealing to changes in consumer tastes. We've also seen, and as a result of some of these activities, the company posted growing revenues in North America, despite a historical trend downwards in soda sales in the United States. But the company is also facing concern over past scientific funding activities and its lobbying activities. In this regard, Sustainalytics is tracking more controversies related to sugar-related funding and lobbying for Coca-Cola than we are for any other food and bev company. And the company has been singled out on allegations that it uses resources to knowingly mislead the public about the health risks associated with sugar-sweetened beverages, particularly by refocusing the debate on healthy weight gain to an individual's level of physical activity. So I think it's important to note here that following these controversies, Coca-Cola has implemented some measures in an attempt to alleviate some of these concerns. In particular, they've set guidelines on the type of research they'll fund, how much they're going to contribute to that research, and the requirement to do that funding in partnership with non-Coca-Cola entities. Nevertheless, the past activities continue to generate some risk for the company, and in 2017, we saw some lawsuits filed against the company that are testing the case that it misled consumers over the health impacts of its products. And this discourse is echoing the debate, the past debate on tobacco, and parallels are being drawn with sugar in this regard. It's not clear to us how this litigation is going to play out. However, we view the litigation as an added layer of risk for the company, in addition to the exposure it's already facing from changing consumer demand and the potential for regulations that would disincentivize consumers from buying sugar sweetened beverages in the future. So feel free to ask any questions on that when we wrap up at the end of the session. But before that, I'll hand it back to Moeen, who will focus on another consumer protection case.
Thank you, Josh. I'll be talking about our story, Antitrust in the Digital Age. In this piece, we discuss the emergence of web trust in the software and services industry and the growing regulatory scrutiny focused on them. While this may have come across as a bit of an unconventional story, the narrative at its core is focused on regulatory and legal risks. So just as a quick background on antitrust regulation, this approach has generally been used to make sure that a public utility isn't abused through market concentration in the hands of a few. This was the case with the breakup of Standard Oil and AT&T, and a key driver behind the antitrust proceedings against Microsoft in the late 90s and early 2000s in both the United States and in Europe. So the question is, why are software companies facing this renewed antitrust risk? There are a few factors driving this that fall under two key themes. The first theme is around this general recognition about the internet as more than a luxury, but a utility, really a public good. This is in part driven by the fact that our digital lives are an integral part of who we are and will continue to be so in the foreseeable future. The second theme is around regulation, namely antitrust regulation. In North America, the approach has generally been to look at price signals to determine whether there is consumer harm being done, though there have been calls to change this approach. In Europe, however, the equation also includes the market environment and whether it's conducive to healthy competition. This latter approach is what's driving a lot of this antitrust risk. With the growing power of internet software companies, such as those that provide platform-based services, there's an increasing awareness that their power is almost limitless and may need to be regulated. So why did we pick Google and its parent Alphabet to profile for this story? And just for simplicity's sake, I'll refer to these two entities as Google moving forward. There are a few factors behind our selection. One is, of course, the historic $2.4 billion fine last June that the European Commission levied on Google for antitrust practices. The second is our own controversy analysis that showed that between 2013 and 2017, Google experienced the highest number of antitrust incidents in the sector. And now, why exactly is Google so dominant? As we all know, Google is a search engine, but it's more than that. It's our entry into the digital world. And alongside that, Google operates a number of secondary products and services. These include Google Shopping, Android, email, Google Pay, many services that we use on a daily basis. If you look at any region of the world, 80 to 90% of searches originate through Google. And Google's done this through an effective algorithm, but also making sure that it appears as the default search engine on major platforms. One example of this is it's been reported that Google pays Apple billions of dollars a year to appear as the default search engine on iOS devices. iOS is one of the two major mobile operating systems in the world, the second being Android, which is owned by Google. As a result of this market power, there have been concerns and allegations that Google is demoting rivals and competitors and favoring its own services when it comes to search results, since it controls that digital entryway. Over the last 10 years, specifically in Europe, the European Commission has conducted and initiated multiple investigations into Google's different products, namely Google Shopping, Android, and AdSense. With the first investigation resulting in a fine back in June 2017, which at the time remains a historic fine. At the time, Sustainalytics issued a special company alert noting that while Google can absorb this fine, the European Commission's decision flags serious or heightened risks to its business model in the long term, because part of the notice from the European Commission was that Google has to implement changes to the way it displays search results, basically requiring it to give equal treatment to third-party comparison shopping sites when search results are displayed. Because of Google's advertising-driven business model, this presents a host of challenges because it does mean that Google will have to give equal treatment to competitors who may not be paying to display their results on when a search is conducted. It also sets precedents for other jurisdictions to look into Google's business practices and sets the precedent for legal challenges from other competitors who can now use the legal channels to recuperate some lost revenue. At the end of the day, this is about the erosion of Google's revenue model and the revenue potential in the long run. Even if this scrutiny is limited to Europe, about 30% of Google's Alphabet's annual revenues come from Europe, which could meaningfully impact its bottom line. There are other signals that this scrutiny is growing, with India's Competition Commission finding the company just last week. There are ongoing investigations in Israel and South Korea, as well as some US states where attorneys general have taken up on investigating Google's business practices. With that, I'll pass it back to Doug, who will cover the rest of our stories.
Thank you, Moin. So the next story that I'm going to talk to you about today looks at physical climate risk in the real estate sector with a particular focus on Asia Pacific. Now, our starting point here is simply that the real estate industry, by virtue of its extensive operational footprint, is highly exposed to the effects of the intensifying physical impacts of climate change. Obviously, this includes things like sea level rise, as well as the growing frequency of extreme weather events. We focus on Asia Pacific because, in actual fact, and by many measures, it's the most disaster-prone region in the world, and is expected to continue to face high risks from floods, droughts, typhoons, and other types of climate impacts. According to a recent UN report, between 1970 and 2016, the economic damages associated with natural disasters in the Asia Pacific region reached approximately $1.3 trillion. So clearly a material concern for large real estate players as well as their insurers. So what we did in the report is we analyzed a basket of about 100 real estate companies that are either based in or have operations in APAC, and we evaluated them on their climate risk preparedness and their overall ESG management capabilities. Now, to be totally clear, we didn't look at what I would call their gross risk exposure. So, in other words, the location of their operating assets and things like that, but it was rather the extent to which management is aware of this risk exposure and steps they're taking to mitigate it. So, as you can see on the slide, we found a tremendous gap in range and performance on this metric among the companies we looked at. As you can see on the pie chart, roughly 51%, just over half of all the companies we looked at, are, in our assessment, generally poorly prepared to manage this risk. This is based either on limited disclosure, or I think even more importantly, just a complete dearth of programs to mitigate physical climate risk across the real estate assets. So we certainly see this as a material risk and an intensifying risk for real estate investors going forward. We ended up profiling Stockland as the industry leader. For those of you who are not familiar, this is a large Australian-based real estate player. What we like about this company, it's doing a lot of good things. It's taken a variety of steps to mitigate its exposure to physical climate risk by doing things like identifying vulnerabilities across its property portfolio. It uses something called a climate adaptation and resilience assessment framework to evaluate existing and planned properties and their exposure to physical climate risk. And what I think is most interesting is it's increased its in-house estimates for things like rain, cyclone, and heat events in its property design and development strategy. So I think, for these and other reasons, we would argue that Stockland is generally well positioned compared to the industry set to compete in this environment going forward. Now, the final piece I'll talk about today in the webinar involves the semiconductor industry, and in particular, the Taiwanese semiconductor industry. And as you'll see in the report, many of our stories are global in nature, and we don't drill down on a specific region, but some of them really are. And we do this not only to tailor the research to a region that we feel is most important, but also just to differentiate the research from some of the other material that we see in the market. So to us, it really made sense to talk here about the Taiwanese semiconductor industry for a few reasons. One is that Taiwan accounts for 3/4 of all semiconductor manufacturing in Asia, which itself is the most important semiconductor market in the world from a production point of view. So what we do in the piece is we really drill down on what we see as two really important emerging risks for semiconductor companies based in Taiwan. The first is carbon regulation. As many of you may know, Taiwan already has a carbon regulatory scheme in place that covers semiconductors, but in our view, the recent launch of China's scheme, which is by far the largest, or will be soon the largest carbon market in the world, we think this might create a type of regional momentum for more regulatory schemes with a little more financial bite. So there's that issue to consider. And the second is energy supply. So not unlike many other industries in semiconductors, energy is an essential requirement for production. Electricity costs typically represent up to 30% of operational expenditures in a typical semiconductor plant. So hugely material. Uninterrupted power is obviously therefore a really important factor in production. And what we saw last August was that with a 5-hour blackout that some of you may be aware of, was that the industry is actually maybe more exposed to energy supply challenges than the market realizes. Production at over 151 companies was negatively impacted by this blackout. And I think when you combine this with energy demand forecasts, the IEA, for instance, is forecasting the energy demand in Taiwan and other parts of Asia is expected to increase by 70% by 2040. You take these two things together and you can clearly see how risks from energy supply are going nowhere but up. So against this backdrop, we analyzed the performance of the semiconductor industry on handling energy supply and greenhouse gas emission risk. And we focused on all of those major companies that are either based in Taiwan or have operations in Taiwan. And we ended up profiling Taiwan Semiconductor Manufacturing Corporation, or TSMC, for a few reasons. As you can see in the chart on the top right, they perform well on our indicator analysis. But I think more than that, they're the industry leader in the 200 millimeter fab production capacity segment, which is particularly important in this industry because of its ubiquity in things like mobile phones and wireless technologies and the like. So some of the things we like about TSMC: the company is already the largest buyer of renewable energy in Taiwan. It's investing heavily in energy efficiency technology. It uses an internal carbon price in project financial analysis, and it also has a dedicated committee set up to extract value, financial value, in carbon credit acquisition and carbon management and things like that. So these are some of the things that we think the company and management is doing well. So that concludes the 10/4/2018 portion of the webinar. And for those of you who follow this series, you'll know that for the last 3 years, we've gone back and taken a look at how our selections from the prior year, have performed over the last 12 months in terms of ESG as well as total returns. So that's something that we continue to do this year. So as you can see here on the slide, this shows the 10 2017 companies. And last year, instead of looking at risk, we really sought to identify 10 upside themes that we feel present attractive opportunities for investors going forward. And we also selected a basket of securities that investors could consider to execute the investment thesis. And we focused on one in particular. And as you can see on the slide, those are the 10 companies that we landed on last year. So half of those companies, BBVA, BMW, GSK, Panasonic, and Symantec, actually saw a decline in their ESG score from a trailing 12-month perspective. But the declines, with the exception of BBVA, were really modest. In some cases, only one point in our model. As you can see on the slide, the horizontal gold arrows, these apply to 4 companies to indicate flat performance. So their ESG score effectively didn't change from January to January. These were Accenture, Barclays, Noble Energy, and PG&E. And for any analysts on the call who cover PG&E, you might obviously be thinking about the California wildfires. For sure, this was a hugely material event for the company, and it definitely did hit our model. It hit the model as a Category 3 incident. But I talked to our analysts about that, and in their view, the negative impact from this one-off incident was offset by improvements that we found over the year in the company's pipeline safety management. So of the 10 firms, it turns out that only Danone experienced a bump in its ESG score. It was only one point, so quite modest. But nevertheless, it was the only company from the 10 that experienced an improvement in its ESG score. From a total return perspective, you can see here in the slide they range from positive 48% for Panasonic shareholders to negative 24% for PG&E, and again, that was largely a result of the lawsuit stemming from its exposure to the California wildfires back in Q4 of last year. So, I do think it is instructive to look back and see what's gone on in the last 12 months, but this doesn't shake our confidence in the underlying themes. We continue to hold those themes that we identified with a high degree of conviction. So, yeah, I think we can wrap up, and I just want to close out by saying, at Sustainalytics we spend a lot of time dealing with metrics and indicators, which of course are hugely important, but sometimes it's nice just to pull back and put those measures in a broader context, in a broader storyline, and that's really what we sought to accomplish with these 10 stories. And we, in addition to identifying these risks that we feel are material for investors in the year ahead, we hope more generally that the report helps stimulate discourse and new ideas about how to incorporate ESG into investors' investment process. So with that, I can pass back to Dana for the Q&A.
Good. Well, thanks, Doug, Joshua, and Moeen for the content overview. The audience will remain muted for the question period just to minimize noise disturbance, but this is just another reminder just to send your questions to us through the interactive chat box. There's only a few so far, so there's a very good chance that we'll get to yours. Doug, I guess the first one maybe is for you. Just can you clarify the process that you used to select the 10 issues? Why were these singled out?
Yeah, that's a good question. Essentially what we did is we harvested insights from our analyst team. So the Thematic team worked with our analyst team, and we bounced some ideas around about and kind of whittled down to these 10, starting from a broader universe. So it was just a mixture of art and science. We tried to get some geographic diversity in there and industry diversity as well. So that was sort of the main driver.
Sure. And Josh, looks like we've got some for you. So it says, regarding Coca-Cola, I think your analysis is good, uncovering the ways in which a company diverts attention away from the main issue, being sugary drinks causing major health problems, and lobbies heavily and successfully against the interest of public health. So what specific sources do you use to generate your rating? Is it a combination of public information, such as lawsuits and news articles, or are you able to glean this info at all from the company itself and their website, SEC filings, etc.? So specifically, while we can see the percentage of revenue generated from unhealthy beverages, how do you get a sense of the company's intentions, motivations, hidden actions that sort of undermine their public sustainability statements? That one's pretty deep.
Yeah, thanks for the question. So like all of our research here at Sustainalytics, we focus on a mixture of corporate documents like annual reports, sustainability reports, etc., and also third-party sources like the media, NGO reports, and that combination of information helps us not only to conduct our research on the different data points that ultimately make up a company's ESG score, but it also shapes our controversy assessments, and also helps us to form our overall view of the company and put it into a context of the trends that we're seeing play out more broadly. So it's definitely a mix of information that we're seeing. I think in general, when we're looking at what the company is doing on the positive end to mitigate risks, we're seeing most of that information come from the company itself, highlighting the proactive measures that it's taking to reduce sugar, to curtail marketing to children, to invest in new brands that are functional or healthy, etc. On some of the more controversial behavior and the allegations that are out there against the company, a lot of that information is coming from the media and from public interest groups. And it's always a balancing act when assessing this information to kind of take both sides of the story and come up with a little bit more balanced approach, and ultimately to let the investment community make the decision on where they think the company performance is. And it's really, I see our job is to provide as much context and balanced opinion as possible.
So then a related question is this: for the example of Coca-Cola, how do you wrap their ESG rating, their sugar issues at large, but their water responsibility is improved? So how does this roll up into the view of the company?
Yeah, I mean, so they're different issues, right? And I think within our reports, we have the opportunity to assess an issue on an individual basis, but then we also come up with an overall view of what the company's performance is. So they're not mutually exclusive in the sense that poor performance on one issue would necessitate an overall poor view of the company. What we try to do is look at the issues that are most significant with regards to that specific company's business model. So where it's selling products, where it's manufacturing products, what the conditions in those specific geographies are, for example. And then as Doug mentioned a little bit before, how when we choose the subjects for the report, it's a little bit of an art and a little bit of a science. When we come up with our views also, I think we're combining a structured approach to data collection and assessment, but also making calls, you know, if you're looking at the ESG report, on the front end of the report where we have our analyst views, we're making calls on what we feel to be the most important issues for the company at that specific point in time.
Okay. And lastly, Josh, can you speak a little bit more about self-regulation of companies and how this plays out in practice on sugary drinks?
Yeah, so I think for beverage companies and also the packaged foods industry more general, especially when we're talking about companies with a significant focus on indulgent categories like confectionery, for example, a lot of the self-regulation that we're seeing, and I mentioned it briefly, I think, in my answer to the previous question, is around marketing to children and the sale of products in certain areas where children congregate, like in schools. And I think, you know, this is, you know, there's a twofold motivation for why companies are doing this. I think on the one hand, these companies, a lot of companies are recognizing the changing consumer habits. Like they're seeing the trend out there that we're seeing. A lot of these companies will identify obesity-related risks as a top-line risk factor in their 10Ks, for example. And I think a lot of these actions are meant to send the right message that we recognize that obesity is an issue and healthy weight gain is an issue. We want to market our products responsibly, especially when it comes to children, because of the way children might interpret advertisements in a way that is different from how adults might interpret them. So in that respect, I think that's kind of the main effort that we're seeing here. And then I spoke a little bit more in detail when I was discussing the case about efforts to reduce sugar in drinks. That's the second element that we're seeing here: reformulating products to make existing powerhouse brands more attractive in the context of concerns about sugar, and also to invest in new brands that are perceived to be healthy. Like Coca-Cola, for example, is doing a lot of this with regards to healthy drinks and juices and teas, and they've got a dairy line as well in some markets. So
sure, yeah, oh, that's helpful, thank you. Doug, I think we'll switch over to you. The question is, it's my understanding that the desalination process is energy intensive and impractical. Is this the best water saving strategy in the industry? So this is referring to the copper mining story.
Yeah, it's true. Desalination is extremely energy intensive, although we're getting a lot better at it. If you think back or look back to desalination, even 4 or 5 years ago, the latest technologies are much more energy efficient than they were back then. But nevertheless, the assumption is correct that it is very energy intensive. I'm certainly not a mining engineer or expert, but I do know that pumping seawater, for instance, or using desalination is certainly not an economically viable option for all mining sites, especially those up in higher altitudes. So there is that, but I think at the end of the day, water is an essential input into the process. So mining companies based in Atacama, region of Chile, need water resources. So I think in some cases there's no other alternative but to go through the rather energy intensive process of pumping seawater or investing in desal.
Okay. And Doug, for you as well, it says for the climate change slide, what percentage of the global real estate market is poorly, moderately, or well prepared? Maybe you could put that slide back up for us.
Yeah, so half in our estimation are poorly prepared. I'd be happy to share the underlying numbers with the listener if they're interested. Something else, for those of you who know real estate, they're a notoriously poor disclosure of ESG information. They're one of the most opaque industries out there when it comes to providing ESG data for a bunch of reasons. So there's that factor too, but it is trending up, and we did get some good numbers here on the actual programs that are out there as well.
And then also, have you looked into how insurance companies are addressing the risks of climate change to the real estate market?
Yes, we have. I've written about that before in a few different reports. It's obviously top of mind for our insurance analysts as well. Insurance companies face massive exposure. A lot of them it's actually, if you think about who's holding the hot potato, a lot of times it's the reinsurers, the reinsurance market for this. But if you talk to management teams in the insurance business, they'll say that it's difficult. They have to do a very, very, very good job at pricing risk, because if they price the premiums too high, you're not going to attract customers. And a lot of these markets are extremely competitive. So in some cases, even a couple basis points can mean the decision between moving from one insurer to another. So they face that pressure too.
Sure. Good. Okay, Maureen, looks like one here's for you. It says, are existing antitrust regulations outdated in the sense that they do not take into account the nature of digital markets?
Thanks for the question. To a large degree, yes, because a lot of the antitrust regulations were developed at a time where there were physical manifestations of monopoly power. But since we've increasingly moving into a digital world, there are really no physical boundaries. The internet is global in scope. So while there's certain aspects of antitrust regulations, such as merger reviews, that can be utilized in this space, most of the laws on the books are largely outdated and don't take into account the nature of digital markets, which of course presents another complexity, because companies are expected to comply with laws that don't necessarily recognize their own business models. So I think there's definitely some room there to revise these laws or add new context to these laws to reflect the nature of companies such as like Google and Facebook.
And then a question more about jurisdictions here. It says, have the software companies faced increased regulatory risk in other areas outside the EU?
Yeah, so just as I mentioned earlier, just last week, the India's Competition Commission fined Google for anti-competitive practices, especially for search bias, and there's other investigations ongoing in India. And the key here is that India is, as an emerging market, it's probably a big potential revenue driver for Google. So already there's concerns that Google might be using its power unfairly. There's investigations in Israel and South Korea, and some attorneys general in the United States have also launched their own investigations. And it's important to remember the Microsoft antitrust case started with a state level investigation in Texas. So who knows how this might evolve, but there's definitely risks on the horizon, as Doug would like to say.
And then more of a general question, I guess, to the analysts. It says, within an industry, are you seeing more agreement on what metrics to discuss or disclose by the companies? Do the companies tend to disclose what their peers are disclosing?
That's an interesting question. I think there's there's a lot of desire on the part of issuers, ESG researchers, and also investors for convergence on the type of information and metrics that are being disclosed. I think there are certain reporting standards that help get us there. So there's the Global Reporting Initiative, for example, but I think there's still a lot of divergence in the market, and I think part of that may have to do with what different companies view as the most relevant information based on their particular operating environment, and also based on the type of data that they're readily able to gather. So I think over the years we're tending towards convergence, but right now we're not there.
Mm-hmm.
And if I may add, alongside the Global Reporting Initiative, there's also organizations like SASB, the Sustainable Accounting Standards Board, that's also developing more materiality-focused metrics. So that's another initiative that's gaining momentum. But of course, like Josh said, they're still a bit far off from mass market adoption.
Sure. And then some general questions, Doug, maybe for you around the report. So in developing the report, what caused you to rethink the design of the ESG analysis philosophy, sort of process and outputs?
Yeah, I mean, the general rationale was simply that this year we wanted to focus more on risk because it wasn't something that we had explicitly targeted before in the 10-4 series. Mm-hmm. So that, yeah, quite frankly, that was the main reason.
Yeah, okay. And then there's some questions about clean water, sort of why were there no water threats, water threat themes sort of featured in the report. And then I would say, dovetailing with that, there's a question around interesting how the demand for EVs is impacting local communities in Chile due to the pressure on local water resources for copper mining. So are all the mining companies in Chile trying to mitigate water and community risks?
Well, so the first point about water, I mean, at the end of the day, there's no shortage of ESG risks taking place in the economy. So I concur that, water scarcity and other types of water issues could very easily have made the list. There was a lot, put it this way, there was a large basket to choose from. We also looked at some water issues in previous reports. We had a dedicated water scarcity report come out in 2016. So that was, I think, part of the reason to maybe shift a little more broadly. As for mining awareness, absolutely. I think you'd be hard pressed to find a management team right now at a mining company in Chile that is not thinking about water. It's absolutely an essential boardroom issue. Nevertheless, what I think is interesting, it's despite that interest that we still find a pretty substantial gap in performance. And yeah, I think in the long run though, you're definitely going to find an uptick across the board in water strategies.
Yeah. Okay. And one more squeaking in here on the semiconductor story. So it says, beyond the dependence on reliable power and energy supply challenges, how will China's new carbon market affect the price of doing business for semiconductor manufacturing in Asia?
That's a good question. I think our semiconductor team may have a more detailed view. I mean, I would say it's too early to say. So China's carbon market is still relatively nascent. If you look at other carbon regimes around the world, generally speaking, they've pushed up, they've pushed up the cost of operating in energy-intensive industries. So I think the default hypothesis would be that it will push up input costs, but it's far too early to say. And our thesis here was simply that, given China's scale and the fact they're moving towards this and have moved towards this national carbon market, it might just create a type of regional momentum for more ambitious regimes.
Mm-hmm. Something to keep an eye on for sure. Good. Well, I think I'll stop it there. I'm going to thank Doug, Joshua, and Moeen again for your content contributions to the webinar. The webinar has been recorded, and so a copy of the recording will be sent to all participants in the coming days. If we didn't fully get to your question, we'll get back to you directly via email in the coming days. And just to highlight too that the webinar only covered 6 of the 10 stories in the 10 for 2018 report. So to read the other 4 stories on diversified chemicals, apparel, financial services, and the aerospace and defense industries, or any other of Sustainalytics thematic reports for that matter, then please visit the Knowledge Center page on the sustainalytics.com website. On behalf of Sustainalytics, I'd like to thank you for taking the time to join us on this webinar today, featuring our new thematic report. And we look forward to updating you next year on these stories. Thank you.